One of the topics I get asked about a lot is escrows and how they work. It can be kind of confusing, so I want to do a quick video to kind of illustrate how escrows work and what that means for your closing. So escrows impact not only your monthly payment, but also funds that you need for closing. What are escrows? So your mortgage payment is going to be made up of several different components. One is the principal and interest that's due on the loan, but also includes your property taxes, home insurance, and if you're in an area that requires flood insurance, earthquake insurance, something like that, that will also be included. If you have a loan that requires mortgage insurance, that will be part of your mortgage payment also. So on the right here, in this example, you can see the breakdown of what a principal and interest payment might be, what taxes might be, and insurance might be, and then you get the total of the payment here. If you have a mortgage or a loan that has escrows included, what that means is that you make this one payment every month to your mortgage company. Included in that payment, we can see, is the taxes and insurance, and your mortgage company sets up what's called an escrow account. Think of an escrow account as like a separate savings account that the mortgage company opens on your behalf, and every month they're going to take out the portion that you pay towards taxes and insurance, and they're going to set that aside in that savings account. You're going to keep building and accumulating money in that account for the next 12 months, and then when your taxes are due and your insurance are due, payments for those bills are paid on your behalf by your mortgage company out of that account because you've been contributing to it over the course of a year. The benefit of doing this is that it helps to budget for some people. It helps to keep a consistent monthly housing expense for your property. There's no big surprises once a year to have an insurance renewal that's due that maybe wasn't planned for. Same thing for your property taxes. There's not a big one-time tax bill that shows up in your mail one day that you haven't accounted for. So it's a way to keep steady monthly payments and budgeting for your housing expense. If there are changes in your monthly payment, it's not because of your interest. If you have a fixed rate loan, the benefit of having a fixed rate loan is that your interest remains the same and your principal and interest portion of your payment is the same for as long as you have the loan. Changes would happen if your taxes go up or down or your insurance goes up or down. Once a year, your mortgage company is going to do what's called an escrow analysis. They're going to get recent tax bills and insurance bills and compare the cost of those to how much is being paid every month by you into your escrow account. If they determine that you're not paying enough into escrow to cover those bills when they're due, then they will raise your payment to the correct amount to make sure enough is being collected. If they find out that you're paying too much, they will reduce your payment, and then in that analysis it will tell them that they have too much in escrow, and they will send you the overage because they're only allowed to have a certain amount. It's regulated. They can only have a certain amount in escrow as a what's called a buffer. Anything over and above that buffer, they have to refund to you. If you do get a refund check, you don't need to pay it back towards your mortgage. That's your money to do with as you please. For closing costs, how escrows impact closing costs is when you buy a house, you have to make sure you have insurance in place. Insurance premiums and policies are a 12-month term. So that means you will be asked to pay a 1-year insurance policy up front at closing. In addition to that, you're going to be putting some money aside to set up and call it seed that escrow account. The reason I do that is because you may close on one day, but you might not make your first payment until could be 6 weeks or a month or close to 2 months. That might be when your first payment is due, and that's when you start contributing into that escrow account. So there's an analysis and a projection done to figure out exactly how much you need to put into your escrow account at the very beginning, at closing, to make sure when your taxes are due and when your insurance bill is due, there's enough that has been accumulating between your closing date and when those bills are due to pay them and pay the correct amount. So some money gets collected in escrow at closing. What happens after you close? That 1-year policy that you paid for insurance, well, that expires in 12 months. A year from closing, when that policy is getting ready to renew, you've already been building money into that escrow account to account for that. So your mortgage company will get a copy of your insurance renewal, and they'll send the insurance company your renewal premium to kick that forward and renew it for the next year. Same for your property taxes. Your mortgage company will get a copy of your tax bill, and they will send the payment for that tax bill to that municipality to make sure your taxes are paid. That's kind of how escrows work. I hope this helps. If you have questions, please let me know, but hopefully that clears up some questions about it.